95% of people who retire early end up paying more in taxes than they need to because they don't know about this. And it's something that I like to call the early retirement tax trifecta. And for many people, if they don't take advantage of some of these opportunities, it could cost you tens or even hundreds of thousands of dollars in taxes. And what most of you will realize as you watch this video is that many people that want to retire early, they have tunnel vision and they only want to focus on this one thing. But luckily, I'm going to show you how to implement all these different parts of the tax trifecta, and you'll see how the results can be hundreds of thousands of dollars in taxes saved if you do it correctly. But before we get into all that, let's talk about the first part of the early retirement tax trifecta, which is deduction optimization. And back in 2017, our lovely government passed the Tax Cuts and Jobs Act, which nearly doubled the size of the standard deduction and limited the amount of itemized deductions you could take. So most of you out there, you might be paying a lot in state taxes, property taxes, and you're trying to deduct your mortgage interest. Maybe you're giving charitably, but are you getting any sort of tax benefit? For example, let's say John and Mary, not real names, are filing a joint tax return here and their gross income is $100,000. If we scroll down here and we bring up things like state taxes, property taxes, which under the current law is capped at $10,000, mortgage interest, gifts to charities, and things like that, you can tally all those up to figure out what your itemized deductions are, which in this example is $28,500. But you see, the government right here will give you a standard deduction based on your age and your filing status. Many of you are probably familiar to this, and that standard amount for them would be $29,200. Now, hopefully you're starting to see a little bit of a problem here. For them, the itemized deduction was only $700 less than the standard, so they didn't have any advantage for deducting mortgage interest or taxes paid or any of the gifts they made to charity. So how can we optimize this? Well, really there's two things. The first action you take now, and one where, might affect you down the line once the tax law changes in 2026. So let's talk about the first one. And if you're anything like John and Mary and you do already give to charity, this is where optimizing your deduction strategy can save you a couple $1,000s in taxes. So just this one little shift here, if John and Mary decide to bunch their deductions in 1 year and they open something called a donor advised fund, and if you already know, a donor advised fund is basically like a charitable checking account where if John and Mary decide to place 2 years of giving, they can take even appreciated stock or employer stock if you have employer stock, or just cash if you want to do that, and put it in a donor advised fund. You get an immediate tax deduction for that year. So here's how they would save taxes if they did do that. So say John and Mary decided to put some appreciated stock in a donor advised fund, so they never had to sell it and realize any gain. And number two, they can sell the stock within the donor advised fund and there's no tax bill at all because it's a donor advised fund. And then number three, they can grant the cash to their charity basically at some point in the future, maybe a one-time basis or a monthly basis, basically however they were doing it beforehand. But what they do get is that large tax deduction in that year. And if we compare the two strategies, we can see here that their itemized deductions are now $9,300 more than the standard deduction, and they can reduce their federal tax, right? Right away, we can see that their tax savings will be about $1,000. So you can just rotate this every other year and save thousands in taxes over your lifetime by doing this. The second thing is that the Tax Cuts and Jobs Act is set to expire in 2026. And although unfortunately many people tax rates will go up, and I'll talk about how to plan for that in a second, the cap on property taxes is also about to go up, or in state taxes. So you see here how, even if you had to pay $20,000 in property taxes under the current law, you're capped at that $10,000 limit, right? So if you aren't somebody who gives charitably, at least now you can itemize your state and local real estate taxes and take advantage of that after 2026. For example, if we were in 2026 and you paid $20,000 combined in property taxes or state taxes, you aren't capped by that $10,000 amount. Many people are unaware that this change is about to take place. Okay, part two, right? Say you're someone with a brokerage account and you want to retire early. If you want to pay $0 on over $100,000 in income, you need to understand the second part of this tax trifecta, which is tax harvesting. This is what many of the wealthy that have retired early have successfully done to optimize their taxes, and can really be a big missed opportunity if you don't take advantage of this. And you'll see how the results are pretty amazing as we go through this. For example, let's say you have an IRA, you want to retire early, and you need $100,000 per year to retire comfortably. So you decide, I'm going to take $30,000 from the IRA to meet some of my income, and the rest we're going to take from the brokerage account. For this scenario, in 2024, you can realize up to $102,000 in long-term capital gains, at least for John and Mary, and pay $0 in taxes. Now, realizing capital gains is not the same thing as creating income. That $102,000 is gains that you realize. You notice they only need $60,000 to meet that income. So the tax harvesting part of the tax trifecta is while you have the chance to do so in early retirement, we could purposely sell more stock than we need to in order to realize those gains while you're in that 0% tax bracket. And then you can rebalance or diversify further from there with the proceeds. So they're still living on $100,000 per year, and they're now paying $0 in taxes. Now, they may have state taxes, right? In California, our lovely government here, we sure do. But at the federal level, they are able to pay $0 in taxes. And many people don't take advantage of this because they're unaware of how this works. That brings up to the one part that many people focus on and have tunnel vision on when they retire early, and that is healthcare costs. When you retire before Medicare and you don't have other options like COBRA or maybe a spouse's employer, your healthcare premiums are likely going to be driven by the amount of income you realize. So for my state of California and my zip code here in San Diego, we'll just take a quick look at this. If John and Mary had a modified adjusted gross income of $0, of course they were able to realize those $102,000 in gains, they would actually qualify for Medi-Cal, which is actually completely different from Obamacare. Many people don't know that. So their insurance would be pretty low cost. But maybe we use a more realistic example. Say their modified adjusted gross income was $50,000 per year. Then we're in a situation where you do have a monthly premium, but you can see right here, you have a nice little subsidy right here. But is that a good thing to keep your income this low in retirement, pay $0 in taxes early on, and pay very little in premiums due to all the credits you get, knowing that in the future you do have an IRA or you do have a 401k, like most people obviously, but will you get crushed in RMDs, required minimum distributions, later on? Many of you are probably saying, why would I want to miss out on, for this example, $18,000 in tax credits now? Well, if that's you, that's a very, very fair question to ask. And it's one you need to ask yourself as you go through your own sort of analysis here. But that's going to lead us to the final piece of the tax trifecta, which is having a tax smart withdrawal strategy. So let's take a 10,000-foot view of how someone's tax bill might look throughout their early retirement. And this is more of a picture for someone who does have a larger 401k or an IRA. So the picture you're looking at my screen is essentially the taxes paid, and it's something I call the tax valley. It's basically showing in those initial years, if you do have a brokerage account for income, your tax bill might be pretty low or even non-existent, and each little bar here is going to represent the taxes you might pay. And now this might feel really good early on in retirement. You might want to give yourself a pat on the back. Your income is pretty low, therefore your tax bill is zero potentially in those initial years. But you can see that the average person with an IRA can get crushed by taxes later on at 73 because our government is not so patiently waiting for you to take IRA distributions through RMDs, right? So to help you avoid this, I'm going to show you the third part of the tax trifecta, and we're going to look at how a tax smart withdrawal strategy might save you hundreds of thousands of dollars in taxes. This is probably one of the biggest things people miss, and it costs them hundreds of thousands of dollars in taxes if they don't do it properly. And here's why. So if you do have a larger IRA or 401k, it's basically debt owed to the government. A lot of people I work with, they're married and they have a joint bank account. What your IRA is it's a joint bank account with the IRS. It's like an IOU, right? So because we don't know how much Uncle Sam's gonna want once you actually do reach RMD age, and your accounts hopefully are growing and getting invested, the IRS is gonna get their portion either way, especially if you wait. But what we do know is that by converting dollars, you're a lot more in control of your taxes and not them. For many people, you don't want to wait until 73. By converting, you can better control your tax rates. You can do some small Roth conversions once you retire early and save a whole bunch of taxes over your lifetime. I'm going to show you exactly how that works in a second. So say John and Mary, they both have $1 million in John's IRA, and they have a brokerage account of around $500,000, and they want to retire today at 60. They actually wanted to retire yesterday. A lot of people come and they tell me, I wish I retired yesterday. What would they be missing out on if they didn't have a tax smart withdrawal plan? Well, for this situation, if we run an analysis and say, hey, based on how they're invested, based on how much income they can generate, if we purposely recognize a little bit of fake income from the IRA and target a specific tax bracket, we don't go wild and convert all of it and just convert that money to Roth, what would we be missing out on if we just kept income low and we just kicked the can down the road from our IRA? Well, for them, it looks like if we optimize the 12% bracket, and again, I want you to compare all your different tax brackets when you do this. I'm just gonna give you the results here versus keeping your income low, you could be missing out hundreds of thousands of dollars in tax savings. So let's go back to our healthcare subsidy discussion. So the math obviously changes and it needs to be unique for you, but you have to make the comparison. Hey, what am I gonna save in taxes versus what I'm gonna pay in premiums? Now, hundreds of thousands of dollars in taxes saved in this example might make it more obvious, but for others, this might look way more, or others, much less, or yes, I'll say do take the credit, right? It comes down to what your actual financial plan looks like, not what John and Mary looks like. So I hope you found this helpful. I'm gonna make a video that goes a little bit more into detail on the retirement healthcare, early retirement healthcare, and Roth conversions specifically. So make sure you hit that subscribe button. But in the meantime, if you are approaching early retirement and you now need to start creating a paycheck from your portfolio, you're gonna wanna know how to allocate, because the math changes as you're getting into those years where you're starting to spend things down, but you still wanna beat inflation. You wanna take some risk off the table. If that's you, you're gonna wanna watch this video that I made going through a $3 million portfolio case study. You can watch that by clicking right here. Once again, this is Matt. I'm a certified financial planner and advisor with 1 Degree Advisors. If you'd like to talk to me or someone on my team about your financial plan, you can click the link in the description below. Thanks for watching.